Okay, so I think we're all starting. So I'll hand over to you, Giles, and you can cover off. And then if we've got any questions, John, at the end, then please feel free to send them over.
Good
Giles.
morning. Thanks for taking the time. So just to set the scene, this is a CPD eligible session, so it's not a sales pitch. It's really much more about what's going on in the cash and banking industry as it pertains to rates, banks, and the use of cash management platforms. Obviously, we will use Insignis as an example of how things work, but as I said, it will not be a sales pitch. The key learning outcomes from the CPD session are to better understand the UK cash environment, to think about mitigating counterparty risk, and to leverage cash deposit platforms. So let's start with what's always the first question, which is around the future of UK interest rates. Just as a reminder, things moved very, very fast between kind of the end of 21, from 0.1% up to 5.25% at the peak. First cut as the central banks around the world then got a handle on inflation was in the UK back in June last year, currently sitting at 4.5%. And our expectations for the end of this year are 3.75. If you'd asked us that question a month ago, I think it would have been 4%. And we are now expecting a further rate cut in the context of the economic impact of the tariff program coming out of the US. There's been endless kilometers on this, but I think the market is beginning to settle down to a consensus range of 3.5 to 4. It's our position that the Bank of England will cut 3 times each of 25 basis points to 3.75. So a little faster than previously expected. I think the other question we frequently get asked is around what's the terminal rate of interest rates? What's the long-term steady state, if you like? And I think that's almost a more interesting discussion, because for decades, the expectation has been in the UK, 2% inflation, 2% rates is the kind of neutral, keep the economy moving forward at the appropriate pace environment. I think there are 2 things going on right now. Number one, greater inflationary pressures around the world. And while tariffs may cause some disinflation in the short term, as excess supply hits different markets and reduces prices, they will undoubtedly be inflationary on a longer term basis. The inflation expectations globally have basically steadily declined since around 1980. And what we're seeing is at least a pause for breath, if not a partial unwind of that globalization theme, which means we should expect inflation generically to be higher for longer. The second half of that terminal range estimate is around the amount of debt sitting on central banks' balance sheets. The UK is currently sitting on between 500 and 600 billion pounds worth of debt. The US, the European Central Bank, etc., vast amounts of money. And although no central banker would ever admit it, I think the concept of having inflation run a little higher, from 2% to 3 to 4%, is probably the only way they can realistically inflate away the value of that debt without putting pressure on the underlying government bond markets by selling too much of that debt on any particular time frame. So for those 2 reasons, one, inflation caused by a slight unwind of globalization, and secondly, the amount of debt on central banks' balance sheets, we expect the terminal range to actually now be 3 to 3.5 rather than that previous expectation of 2. The other big theme that we've obviously seen in the UK over the last few years is, people actually using banks and banks actually needing savers. I know that sounds like a strange thing to say, but if you go back to various different crises, all the way back to 2008, through the European sovereign crisis, through COVID, through various different other periods of instability, central banks around the world have provided facilities to banks for banks to borrow directly from the central bank at very competitive rates. One of the offers to UK banks in the last few years was borrowing 4-year money at 0.25%, for example. So the helicoptering is the slang phrase for it, but dumping money into the system, both by quantitative easing, but also by offering very, very cheap money to the banks. that has come to an end, or is at least in wind down. So that means that the banks need to go back to where they traditionally should get their deposits from, which is good old-fashioned savers. At the same time, you've got the challenger bank dynamic. More than 30 neobanks have launched in the UK over the last 15 years or so. That provides more FSCS capacity for financially advised clients. And those challenger banks don't have a bricks and mortar cost base, and generically offer higher rates because they can, from a cost of acquisition perspective, not having to fund those buildings, those branches. The other side of the balance sheet is obviously banks will only need the amount of deposits that they require to then on-lend. So we are seeing a forecast in mortgage lending to rise by about 11% to 2025, which is a pretty healthy growth rate. Obviously, there's some correlation there to interest rates beginning to come down. And then, of course, from the other half of consumer behaviour, are there plenty of savings available to those banks? And the short answer is yes. The UK consumer savings ratio is currently above 11%. To give you some context to that, so the long-term average is around 7 to 8%. The peak that everybody remembers back from COVID was about 25%, and the number has dropped down, but has stayed slightly elevated versus the long-term average. There's plenty of liquidity available to banks, but the good news for savers is that there's more competition for that liquidity. And then finally, as mentioned before, the central banks are removing those funding schemes, what we've loosely called the acronyms TLS, ELM, TFS, etc. And they're also reducing their reliance or their purchases in the gilt market, reduce that from 800 billion to 530 billion. So that effectively that's two elements of quantitative tightening, taking liquidity out of the system, which again pushes the responsibility back onto the banks to fund their balance sheets from savers as opposed to the central bank. So where does that all leave us? All of those themes, if you like, come together to a relatively attractive savings environment for consumers, for companies, for charities, for all the different client types that we work with. Above 4% across the board. The other paradigm here is there's quite significant depth. You can see that the top three rates in 1 year fixed term, for example, from this sheet, there's only 11 basis points separating them. So it's not just one or two outlying banks that happen to need money and therefore offering an attractive rate. There's quite significant depth in the respective products as well. And then the final point about rates is that you'll notice that much like the shorter dated gilt curve, the curve is very flat. So you're not really getting paid a lot of money to tie up your liquidity for long periods of time. So your initial reaction would be, well, in this environment, why wouldn't I put everything on easy access? Because I get all the liquidity I need and I don't really compromise on rate. There is a quid pro quo to that, of course, which is that if you have a view that rates are coming down and you want to lock in what may historically be seen as attractive fixed term rates, and we do see quite a lot of clients in that kind of 1, 2, 3 year space because they have a perspective that they can plan and enjoy 4 to 4.5% for longer periods of time. So it is essentially the client taking an interest rate view beyond the kind of easy option of saying, I'll just stick it all in the shorter dated products. The other big theme is that I think a lot of people see the cash deposit platforms as all about rate. And that's only half true. There are two dynamics to using a cash deposit platform. One is risk management, and the other is interest rates. So 99% of our clients use more than one bank. And so actually they are, if you think about it, they're putting £85,000 into multiple banks from an FS, or it's a large corporate putting £1 million in each of 10 single A rated banks. They're actually prioritizing risk management before they prioritize rate. So as long as we have the risk management parameters, i.e., I want my deposit portfolio limited at FSCS protection, and the liquidity parameters, easy access, 3 month, 12 month, then basically it's mathematical. What's the highest yielding portfolio in the context of those two perspectives? So the bank diversification and the risk management piece is a much larger part of the cash deposit platform than perhaps is generally understood. And from an FSCS perspective, it's probably worth pausing and saying the PRA, part of the Bank of England, did announce recently that they're expecting to raise the FSCS protection limit in December 2025 from its current 85,000 up to 110,000 pounds. It is, at the moment, it is a proposal. It is our view that the PRA doesn't make proposals unless they are well thought through, and there's a reasonably high likelihood of things being executed on that basis. So it's our position that it's highly likely to happen, and that will help all savers with material amounts of money, whether it's individual consumers or whether it's SMEs, corporates, charities, etc. And if you think about what drove that, the starting point for that conversation as to raising the numbers was the Silicon Valley Bank episode, which is almost exactly 2 years ago now. And the concern around Silicon Valley Bank was not necessarily individual consumers losing money. The concern was more that lots of companies, in Silicon Valley Bank's case, particularly small and medium-sized tech companies, would lose significant amounts of money because they had far more than the US equivalent of FSCS protected money in the bank. They wouldn't be able to make payroll, then you have redundancies, and you have this sort of knock-on effect into the corporate space separately from the consumer exposure to a particular bank. So actually, what triggered this whole review and with this likely manifestation at 110 is not really the consumer space at all, it's more the corporate space. Why 110,000? The perspective on that is the inflation adjusted number for when the number was set at £85,000. The original 85 was to be correlated to the European version called the European Banking Guarantee Mechanism, which is €100,000, but obviously post-Brexit, there is less requirement for that correlation. So the UK can tread its own path as to where it sets the number. So Europe's €100,000. We are likely to be £110,000, and the US, where everything is bigger, is $250,000. The final point on this page is temporary high balance. So it's a very useful tool that's not commonly known that the FSCS offers for single liquidity events. If a client sells their primary residence, doesn't apply, for example, to investment properties, but their primary residence, and in many other very specific scenarios, the FSCS will protect the first £1 million for 6 months in any individual bank. So that can help you put your clients' minds at ease that if they sell a business, sell a house, have an inheritance, get a divorce, any of these other liquidity events that they may go through in their life cycle, their money will be protected. And then beyond that, they can then think about spreading that money around, but at least they've got that first 6 months to breathe easy. There is a whole world, of course, beyond FSCS. People think a lot about FSCS, but if you have a client, particularly it might be a corporate or charity client with much larger amounts of money, FSCS won't cover all of that. So what tends to happen there is we need to think about what we call counterparty risk. So you move beyond the FS discussion into the credit ratings and the name comfort around the banks that your clients may place money with. And that usually manifests itself in some sort of treasury policy. It might be tiered, as the example in the middle of the slide, where you can use as many banks as you like, up to £85,000. Tier 2, you might need an investment grade rating, BBB or better. And tier 3, you might say actually beyond a certain amount of deposit size, it's got to be with a single A rated bank, for example. So the Insignis panel of banks incorporates both challenger banks, but it also includes a very large number of bigger global banks with strong credit ratings, so that if we have clients that go beyond FSCS risk management function, that there is a balance sheet and product available to them. So if you think about benefits to clients of using a cash deposit platform to both reduce risk and to increase return, there's diversification, obviously. It's optimizing returns. And optimizing doesn't just mean when the cash is initially placed. It also means on an ongoing basis. So, for example, if a 1-year term deposit is coming up for maturity, we send a message to the client, copying the financial advisor, saying this is coming up for maturity, please have a think about what you would like to do with it. That goes out 2 weeks in advance. A second message goes out on the day of maturity. So the point of the service is not just to get an initial deposit portfolio set up, but also to make sure those funds are at the efficient frontier from both a risk and return perspective on a long-term basis. And then finally, kind of the hardest yards of building our business is to make sure that clients can have a single application form, a single portal, and that gives them access to all of the 49 banks on our platform. So there's a diversification piece, there's a return piece, and there's an efficiency piece. So what does that look like in cash flow terms? Once a client has opened an account, the Insignis account is actually held in a Barclays account within the client's own name. The client is the beneficial owner at all stages. And they would make that initial deposit, and then they would have the ability to choose any of those 49 banks or the deposit products that they offer and begin to build their own portfolio. To me, the cash piece has been an anathema for a while. No advisor or client would consider an equity portfolio with one share in it, and yet clients very happily put all their cash into one single bank. So we're looking to diversify that cash, but also bring the cash into the financial advice dialogue. There's also a perception that this is really mainly for individuals. A very significant part of our business is with institutional clients, whether that's, as I mentioned earlier, SMEs or large corporates, or, for example, the not-for-profit space, charities, schools, academies, universities, etc. Two other important buckets that I think it's worth highlighting as available to your clients is one, the pension bucket. You see a lot of activity with cash in a SIP or cash in a SAS. And then the other final bucket is what we call specialty clients. So court of protection, power of attorney, trust clients, where it's really quite complicated to try and do these things on the high street. If we can open up half a dozen savings accounts for a court of protection client in 48 hours, that we hope is a very value-added service both to you and your clients, particularly at a time when the last thing the client wants to be thinking about is the UK banking industry. They've got far more important things to be focusing on in the context of court of protection, power of attorney, etc. Each individual client may or may not have a large amount of cash in their balance sheet on any given day. But what we do see from our financial advice distribution partners is liquidity events. Really quite a significant number of liquidity events that might be based, as I mentioned earlier, around an inheritance, might be moving from one asset class to another, so coming out of the equity market for a period of time or permanently. It might be house or land sales, it might be business sales, divorces, etc. So it's not just for high net worth individuals, it's for all individuals in the UK within your client base that may have one of these liquidity events during what we call their cash life cycle. So if you bring this to life in numbers terms, if you have a client with £750,000 in High Street Bank earning what's a kind of generic current account interest rate of 1.15% at the moment, if that's moved into a cash deposit platform, then the FSCS coverage goes from 11.33% eligibility up to 100%. The rate goes from 115 to 438, and the amount of interest they earn goes from just over £8,500 to more than £32,000. So very significant risk reduction and return improvement through the use of the cash deposit platforms. So bringing it to life not just from a sort of economic and risk perspective, but also from a visual perspective, I think it's very important to mention not only can the client see their deposit portfolio in one place, they can move money around, they can withdraw, they can add funds, they can give notice, etc. But also the financial advice community can see this as well. So when a financial advisor introduces a client to the Insignis platform, they automatically have read-only access to be able to see what their client can see. So when I mentioned earlier about bringing cash into the financial advice dialogue, this is what I mean. There are numerous functions on the platform to allow summaries of interest received, historical transactions like a consolidated bank account, and various different other reports that may be useful both to you and your clients. And then for the financial advice industry's benefit, we are integrating the service into a number of the bigger CRM and front-end platforms in the UK. So we're already integrated, for example, to Intelliflo, to Iris, and to Money Info. So if any of you would like to use the service, but also have the ability to execute it through those systems, we would be delighted to have that conversation. So we talked a bit about the client benefits. Thinking about this from the advisor's perspective, the first benefit that we get from a feedback perspective is complete oversight. Again, historically, cash sat slightly separately from the mainstream financial advice dialogue. It may have been in a commercial bank, it may have been in national savings, but what it wasn't was integrated into the broader, more holistic picture and conversation. So this gives you a much greater level of clarity down to the last penny from a risk and return perspective of where your client's cash is, and helps integrate that into dialogue around what may be appropriate from a tax planning perspective or an investment perspective. We hope it provides significant value to your client service proposition. Again, if a relatively light touch process, because it's a referral from financial advice individual to Insignis, can reduce risk significantly and quadruple the amount of income they're generating on cash. We believe that is a significant client benefit and a significant enhancement to your client service propositions. Finally, we're talking about sort of the relationship piece of the jigsaw. If the cash sits inside your purview, inside your dialogue, it's less likely that someone else is having a dialogue with your client around that pool of cash that might otherwise be visible to the respective bank with whom they're holding that money. And then finally, we're seeing more and more requests from financial advisors to present alongside them to their professional networks partners. So where financial advice overlaps with the accountancy or legal industry, at that point in time, the client's nearly always in cash. The requirement for that dialogue is usually some sort of event, like some of the liquidity events I mentioned earlier on. And so it's proving to be a very useful service to wrap your arms around the client and the cash position that they have, and then buy time for all parties to have a longer, more holistic dialogue around tax, investments, and everything else that the financial advice industry offers. We do a lot of work presenting with financial advisors to those professional networks, and the inquiry from those professional networks is channeled back through the financial advisor. So, as I mentioned before, there are many component parts to financial advice. Bringing cash management into that, to use some examples, for example, if you get into a situation where you're copied on an email that a 1-year term bond is maturing, £85,000 is coming back to your client's hub account, that has frequently triggered constructive dialogues about, okay, is that the pool of money we should then set aside for ISA this year, for the pension contribution this year, etc., etc. So as you receive those emails, it provides catalysts for dialogues across a more holistic plan. It's really important to stress from an Insignis perspective that we don't run a direct-to-consumer business. Our distribution channel is through financial advisors, and as such, obviously, form built for the client, which the advisor can see, but there's also a separate, I think what the industry might call an advisor's zone, what we call a partner portal, which allows you and your teams to log in and see everything to do with cash, both from a functionality, an information, and a training perspective. You can generate or request illustrations, think of them a bit like quick quotes, You can sign up clients, you can access the platform, you can set up the integrations piece, etc., etc. So it's a single portal, and if any of the advisors or their power planning or operational teams would like access to this, then we'd be delighted to provide that. And then finally, obviously, from a peace of mind perspective, we just wanted to stress we are regulated as a payments company. We do not move a single penny without an instruction from either the client or the financial advisor. The client remains the beneficial owner of funds at all times. No money is ever exposed to Insignis from a counterparty perspective. Two-factor authentication is required on all transactions. And as I mentioned, we are regulated both to run the payments piece through the Payment Initiation Service Provider regulation, and also provide that front end, which shows multiple banks in one place through a separate regulatory bucket. There is a client services team in Cambridge to look after client inquiries, and there's a financial advice team split into account management and advisor services based in London to look after the financial advisors with whom we work. So there's human beings in the UK who are there both to support the financial advice partners and also to support the end clients. That brings the formal component part of the presentation to an end, but I'd be delighted to take any questions.
Okay. Sure, we have any questions on that side, Giles, but really appreciate your time and taking us through everything on the UK banking aspect. I will be in touch with everyone. The recording for this will be sent out centrally by Julian Harris, and I will be in touch to speak everything Insignis. If you would like a demonstration of how the platform works and need any information on the Insignis side, please do reach out. Be more than happy to help. But I really appreciate your time today, Giles. Thanks for that, and I'll catch up with everyone very soon.
Thank you, everybody. Cheers.